Breaking news. Global financial markets are experiencing renewed pressure as the US dollar continues to strengthen, driven by expectations surrounding Federal Reserve policy. This movement is not happening in isolation. It is reshaping global capital flows, impacting emerging markets, influencing commodities, and increasing volatility across the world economy. Here is what is happening and why it matters. Over recent months, investors have increasingly priced in the possibility that U.S. interest rates will remain higher for longer. Even as inflation shows signs of easing in some areas, the Federal Reserve has maintained a cautious tone, signaling that it is not ready to declare victory over price pressures. This stance has had a direct and powerful effect on the US dollar. Higher interest rates make US assets more attractive to global investors. As a result, capital has been flowing into dollar-denominated investments, pushing the value of the dollar higher against major global currencies. A stronger dollar reflects confidence in U.S. monetary policy, but it also creates significant challenges for the rest of the world. For many countries, especially emerging markets, a rising dollar tightens financial conditions. Governments and corporations that have borrowed in dollars now face higher debt servicing costs. At the same time, capital flows out of riskier markets and back into U.S. assets. This shift increases financial stress and limits economic flexibility for countries already facing growth challenges. Global equity markets are feeling the effects as well. When the dollar strengthens, multinational companies face pressure on earnings as foreign revenues become less valuable when converted back into dollars. This dynamic has contributed to increased volatility in global stock markets, particularly in export-driven economies. Commodities are also being impacted. Most major commodities, including oil, metals, and agricultural products, are priced in US dollars. As the dollar rises, these commodities become more expensive for non-US buyers, which can reduce demand and weigh on prices. This relationship has been clearly visible in recent market movements, as commodity prices fluctuate in response to shifts in the dollar. The bond market provides another important signal. Rising expectations of prolonged, tight monetary policy have pushed bond yields higher at times, reflecting both inflation risk and strong demand for U.S. debt. These yield movements reinforce the dollar's strength and influence global borrowing costs. Meanwhile, currencies across Asia, Latin America, and parts of Europe have faced increasing pressure. Central banks outside the United States are now forced to make difficult decisions of their own. Some may raise interest rates to defend their currencies, even if domestic economic conditions remain weak. Others may allow their currencies to weaken, accepting higher inflation as a trade-off. This is how Federal Reserve policy extends far beyond U.S. borders. Cryptocurrency markets have also responded sharply to dollar strength. A stronger dollar typically signals tighter global liquidity, which tends to pressure risk assets, including digital currencies. Bitcoin and other cryptocurrencies have shown increased sensitivity to dollar movements, reacting quickly to changes in interest rate expectations. These reactions highlight the interconnected nature of today's financial system. Geopolitical tensions are adding another layer of complexity. Ongoing conflicts, trade disruptions, and political uncertainty have increased demand for safe haven assets. In this environment, the US dollar has benefited from its role as the world's primary reserve currency. This combination of monetary policy uncertainty and geopolitical risk has amplified global market volatility. For investors, this creates a challenging environment. Markets are no longer reacting solely to economic fundamentals, but to expectations about future policy decisions. Small changes in inflation data, employment reports, or Federal Reserve communication can trigger outsized market moves. As a result, volatility has become persistent rather than temporary. Looking ahead, the direction of the US dollar will depend heavily on incoming economic data and signals from the Federal Reserve. Investors are watching inflation trends, wage growth, and consumer demand for clues about whether interest rates will remain elevated or eventually begin to fall. Any shift in expectations could alter capital flows and reshape global market dynamics once again. Until clearer guidance emerges, global markets are likely to remain sensitive, reactive, and unstable. The strength of the dollar is not just a currency story. It is a reflection of global uncertainty, policy divergence, and the far-reaching impact of Federal Reserve decisions. This is why Fed policy continues to shake global markets. This is GeoMarket Report. Stay informed.
Key indicators such as wage growth, services inflation, and consumer demand will shape the Fed's next move. Breaking news from the world of finance. The Federal Reserve is now facing one of its toughest challenges in decades. It's a high-stakes balancing act, a tightrope walk between taming rampant inflation and preventing a full-blown economic recession. Every move they make is under intense scrutiny, and the consequences of getting it wrong could be severe for all of us. This isn't just a headline for Wall Street, it's a story that will impact your wallet, your job, and the future of the economy. So, what exactly is happening, and why is the Fed in such a precarious position? Let's dive deep into the numbers and the decisions that will shape our financial future. Recent economic data has painted a very confusing and contradictory picture for policymakers. On one hand, we're seeing some positive signs. Inflation in certain areas, like goods and energy, has started to cool off. This is the good news the Fed has been hoping for, suggesting their aggressive interest rate hikes over the past couple of years are finally starting to work their magic. However, it's not a clear-cut victory. In other crucial sectors, particularly services, inflation remains stubbornly high. Think about the cost of things like rent, healthcare, and dining out. These prices are not coming down as quickly as we'd like. This persistence is a major headache for the central bank. But here's the real twist in the plot. While the Fed has been trying to slow the economy down, the American consumer and the job market have been surprisingly resilient. Consumer spending continues to be robust. People are still going out, traveling, and buying things, which keeps demand strong and, unfortunately, puts upward pressure on prices.